main event for fixed income market in July will again be the Fed. The Fed is widely expected to cut interest rate by 25 to 50 basis points, possibly. That has already contributed to very sharp decline in yields to about 2% in the 10-year treasuries. The same is true in Europe, where the ECB has pretty much restated its message that policy is likely to be eased going forward. As concerned investors, there's considerable inflows into bond funds, chasing the last bit of yield that exists in both sovereign and investment-grade credit. We find value still in investment-grade credit, but it's harder to justify buying into high yield, as the 2-year, 3-year segment of the part offer negative yields. We do find value, however, in the emerging markets, where yields of 6% are common, especially for good quality sovereigns. So we're confident the emerging market will do well. Well, in the equity market, monetary policy is also a key driver, especially in the recent rally. The trade war truce was also a positive, sentiment improved, and that probably alerted some investors back into the equity market. However, the bulk of investors are really underinvested in equity, so maybe the second half we'll see a bit more flows flowing into the equity market. I think the dividend yield of 3.5% in Europe is one key element that could spur investing in equities. As a conclusion, performance has been phenomenal across a wide range of assets. Year to date is likely driven by central bank for the most part. We do signal that volatility is being low. I mean, it provides the opportunity to hedge portfolio at a cheap level. So investors would be keen on doing this.